Watch his exceptional story, Pursuits by Škoda, only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Crude oil extends decline to the fifth day to trade near the bear market territory as fears of a global recession rise. The Reserve Bank of India will not approve S.R. Bartley Boy and Company for auditing banks this financial year after the regulator found lapses in an audit assignment. Fitch Ratings downgrades ICICI Bank and Axis Bank to a BB plus from BBB-, citing operational challenges in India's banking environment. The outlook remains stable. And Larsen & Toubro plans to sell up to 3.88% stake in L&T Technology to meet SEBI's minimum shareholding norm. The floor price for the offer for sale has been set at 1650. Well, let's take a look at the trade setup for the day. For a change, it doesn't look all that great for India as well. And that's in part due to how the world is shaping up. There's only as much that India can keep on doing before it catches on with the world. So firstly, what happened around the world? I think the FANG stocks hit the US markets and dragged them lower. It wasn't that way for a bit for the entire day of trade, but post that verdict on Facebook, and opinion is divided about how much damaging it is for Facebook, but that's the problem of the Facebook shareholders. What this did, and you will see that in the US markets as they come in, the FANG stocks dragged the Nasdaq lower, and overall there was a bit of a problem for the US markets as well. So we're doing reasonably okay. The Dow in fact ended in the green, but the Nasdaq was down about 1.6%. It's showing in the way Asia is trading as well. The whole trade war fears, and if the markets are not going to do that well, what would happen to the rest of the world? So the Asian markets starting off with a tick of red, and the SGX Nifty for a change indicating a start in the green. I don't think too many people have reasons to complain. If anything, this might be healthy because we've just gone on and on when it comes to what the Indian markets have done. So maybe a bit of a pullback is necessary as well. Just keep in mind, while we're talking about what the RBA will do today or what the ECB will do on Thursday and what the Reserve Bank does on Thursday, the big daddy remains the Fed. And FOMC voting member James Bullard has said that an interest rate cut may be warranted soon due to potential impact of global trade tensions as well as very weak US inflation numbers and the impact that it has on economic growth. So the clamor for the rate cut definitely rises. What does all of this do to our markets? Well, we'll start off lower as the SGS was indicating, and keep in mind, yesterday was a broader rally. So it'll be interesting to see if we indeed find some support, because in yesterday's session, we didn't see as much of banks as we saw autos, metals and FMCG contribute, with HUL doing what it did, some of the auto names doing what they did yesterday. This was the activity in the markets yesterday and not centric on banks, so it'll be interesting to see. But banks would be interesting in the session today because ICICI Bank and Axis Bank, and if they go down, would be important ones to monitorable, and whether or not they have an impact on the Nifty bank in trade today. And of course, watch out for crude. That continues to go lower as our headline suggested as well. And typically in the past few instances we've seen, I mean, there's a wonderful chart which explains and shows how while crude, which was the blue line, stayed steady, the Indian markets were steady, but the last few days, due to crude impact and other impacts, with crude coming off, there's a bit of an uptick on the Nifty despite the elevated levels. So interesting to see what happens going ahead. The stocks to monitor in the session today, well, I would watch out for L&T Tech, not because of any other reason, but for the fact that there is a sale that's going to happen from Larsen & Toubro's side to maintain their stake. So L&T will sell about 3.88% stake at a floor price of 1650 per share. So do watch out for this one. Could start off lower. Swaraj Engines, interesting one. Mahindra & Mahindra has acquired 1.77 lakh shares. Not big one, and they are associated, of course, but at 1387 per share. The Fitch downgrades on ICICI Bank and Axis Bank. Let's see if they weigh in on the stocks. The long-term issuer default rating downgraded to BB plus from BBB minus. Of course, the senior unsecured debt rated at BB plus, and the outlook is stable. Similarly, for Axis Bank, the long-term issuer default rating downgraded to BB minus. Does this have an impact? I'll weigh in on this on first word. But there might be a sentiment impact nevertheless on these stocks. Let's wait and watch. And lastly, GE Power. Normally I don't talk about this stock, but a large order from NTPC JV for engineering work, 738 crores. Should be interesting for GE Power as well. Let's see what it does in the session today. Not a very liquid stock, but could be active. Let's tell you what's lined up on First Word today. Firstly, Vishwan Nair will explain the regulatory action taken against SR Bartley Boy and Company. We then talk to former ICAI President Amarjit Chopra for his perspective. Then we go through the rationale from Fitch for downgrading ICICI Bank and Axis Bank's foreign issuances. Corporate India debt saw the sharpest spike in 5 years in FY19. Sumit Sarkar will bring us the list of companies that have borrowed the most. And finally, branded innerwear makers too are facing a demand slowdown. Agam Vakil will tell us all about it. The RBI has barred SR Bartley Boy and Company and an EY firm from conducting statutory audits of commercial banks during the current financial year. This is after the regulator found certain lapses in an audit carried out by the firm. Vishwan Nair reports.
The Reserve Bank of India on Monday has said that SR Bartley Boy & Co., the chartered accountancy firm, will not be allowed to take up any statutory audit duties at commercial banks for at least a year, starting from the 1st of April 2019. Now, according to what the Reserve Bank of India has done, this is part of the enforcement framework that the Reserve Bank of India had created last year, where it had said that if it finds that a certain auditing firm has been lacking in its duties, or if there are any lapses in the assignments undertaken by this auditing firm, that it will be empowered to take action against such a firm. Now, in the statement about SR Bartley Boy & Co., the RBI points out that it had found certain lapses in the way that that this company had done previous assignments on statutory audits, and therefore it was initiating this action. It is not yet clear on which bank's case has the RBI found these lapses. However, it is important to note that the RBI points out if these lapses have resulted in the misstatements of financial results by certain banks, then obviously the RBI will take action against these companies. Now, SR Bartley Boy & Co., from what we know through public records, is the statutory auditor for large private sector banks, including HDFC Bank, Kotak Mahindra Bank, as well as IndusInd Bank. Apart from this, it used to be the statutory auditor for Yes Bank back in 2016. And if you remember, back in the day, Yes Bank had reported large gross NPA divergences after the RBI undertook the asset quality review of 2015 and 16. Not only that, it again reported large divergences in the following financial year. And because of this, it is said that Rana Kapoor, the former MD and CEO of the bank, was asked to not continue his term beyond 2019, January 31st, because of which he actually had to leave the bank, and a new CEO had to be appointed at Yes Bank. Now, again, just to make it clear, the RBI has not specified which bank it is talking about when it is saying that certain lapses were found in the auditing assignments. However, it is important to notice that all of these other banks will likely get impacted in the coming year.
Well, it's an interesting verdict. It's a big verdict in that. I don't remember in my memory in the recent past that such a verdict has been passed. But let's ask somebody who's closely associated with auditing, and the former president of ICAI, Mr. Amarjit Chopra, joins us right now on the show. Mr. Chopra, thank you so much for taking the time out and speaking to us.
Thanks a lot.
What have you made of the verdict that came out yesterday?
See, I have a very mixed feeling, very frankly. Mixed feeling in the sense that RBI has debarred SR Bartley Boy. It's a good thing that if at all someone has been found wanting in the performance of the professional duties, probably it requires to be done. But at the same time, my mixed feeling comes from that how many discipline mechanisms probably the auditing firms should be facing. Now, SEBI in one of the cases debarred PwC. Now, Reserve Bank of India is doing here. NAFRA is there. NCLT might also do in certain cases. MCA may do in certain cases. And institute in any cases there. So that is what worries me. How many discipline mechanism an auditor is going to face? The problem has been that CA Act never permitted an action against the firms, which we even wrote to the government at different points of time that we want to act against the firms also. But we can only act against the members. My worry now stems from the fact that once now SR Bartley Boy has been debarred by RBI for, I don't know which bank they are referring to, Now, institute will also have to take action against the concerned member because it becomes an information. It's in public domain. It is known now to everybody that SR Barley has been debarred by the Reserve Bank of India. Now, institute will have to start its proceedings, or NAFRA may be starting its proceeding against the concerned members also. So that's a cause of worry to me because there should be one disciplinary mechanism, basically, for any professional institute.
So, okay, fair points, all of these. I'm guessing the market or the people that I spoke to believe that this might concern a particular bank, if at all, and all of these are conjectures. I won't get into that, Mr. Chopra, but my larger question is, do you think this sets a precedent? And it could be a dangerous precedent, it could be a timely precedent, it could be precedent which some people might laud as well, but do you think this sets a precedent for what could happen in the future as well regarding similar cases, if I can use that term, sir?
This definitely sets a precedent. There is no doubt about it. I'm in no doubt at all so far as this part is concerned. But at the same time, I want to raise a much bigger issue. After all, this bank has not been inspected for the first time. This bank has been inspected even in the earlier years. I'm not getting into which bank it is, because year after year, after the auditors have actually completed their work, the banks have been inspected by the Reserve Bank of India inspectors. What action the RBI proposes against its own inspectors who actually failed to detect these deficiencies in the earlier years? All the commercial banks today, including the public sector banks, are going to have been inspected all these years basically, and the private sector banks also. Now, this is going to trigger another point that even in respect of the public sector banks, where the audits have been performed by the other firms, which are non-Big Four firms, the similar actions may follow. I don't mind the actions being followed, but at the same time, if the principle of equity has to be applied, then the same principle must apply to the RBI inspectors also, those who conducted the inspections in the earlier years. And if you really ask me, RBI itself has been granting exemptions in the specific cases for non-following of the prudential norms. What do we say about it? After all, when we talk of the financial discipline, everyone knows what is happening in the agricultural loans, what is happening in mudra loans, what is happening in certain other loans. What kind of financial discipline we have been able to actually set in all these years. I don't mind action against the auditors, but two things I would like to say. Number one, there should be one disciplining authority, and most probably that should be the institute. Now, of course, NAFRA has come in. No, it means RBI has gone even above NAFRA, if you ask me from that angle. And in any case, they have gone above institute. But similar pattern may be followed by SEBI also tomorrow. Now, if somebody asks me that SEBI will also take action, then what the SEBI people have been doing all these years? So my worry is that when we are trying to discipline one profession, we should be looking at what we have been doing in cases of our own internal inspections. If RBI acts against its own inspectors also, I will say the principles of equity have been followed. If they don't act against their own inspectors who conducted all these inspections in the earlier years, I think it has been unfair to a particular profession.
Okay. I do hope somebody's listening into this, or somebody will listen into this a bit later on as well. Mr. Chopra, my final question. Yesterday when this news came out and we were talking to experts and within ourselves as well, there were 2 points. One was the nature of the verdict. Two is the quantum of the verdict as well. It's not often, or I don't remember I having seen such a long sentence being passed. Is it too harsh a verdict in your mind, even if the nature of the verdict was?
Let me say that firms have not been debarred in this country earlier. PwC was debarred by SEBI, but that order is yet to be implemented, if you ask me, for any reasons. So I will not say that the order, I can tell you at least 4 cases I know from the institute where we have debarred the members lifetime members. because the act only permitted us to act against our own members, not against the firms, basically. So it is not that the punishment is too harsh. After all, if at all the financial statements were falsified or were not actually reflecting the true and fair view, how many people lost money on the stock market, I can't say, basically in those particular years. So I do not say that the punishment is too harsh for that matter. But debarring a firm from one audit should then also trigger debarring of this particular firm by SEBI also, by MC also, by some. After all, if a person is guilty, if a firm is guilty of misconduct, they are guilty in all other fields. Why only for the Reserve Bank of India purposes? And if that happens, I think it becomes too harsh.
Okay, Mr. Chopra, appreciate you taking the time out this early in the morning and talking to us. Thanks much.
Thank you. Thank you.
For a lot of you who, well, may not have looked at news post-market hours, this is the big news that happened. From an audit perspective, from actions that the Reserve Bank takes, this is not something that we see too often. Okay, let's move on to the next piece on First Word, and very quickly I'll just dwell upon this for a bit. This is reasonably big news. Fitch Ratings has downgraded the long-term debt and viability rating of ICICI and Axis Bank's foreign issuances. The ratings agency cites the challenges that the two lenders in the operating environment for the downgrade. So what's happened? Yeah, well, let's just quickly tell you. What's happened is that both the ratings from BBB minus have been downgraded to BB plus. So that is one big thing. Remember, this is not on the local paper, but for a global fundraising, etc. perspective. So keep that at the back of your mind, and I'll tell you why brokerages believe this might not be a really big thing. But let me first tell you the reasons cited by Fitch for the downgrade. They believe that the tough operating environment for the banks, the regulatory framework within which they operate, the near-term outlook, and they've cited, the inadequate capitalization as and other reasons as one of the reasons why the near-term outlook seems a bit cloudy, according to them, for these two in particular. And the comparison with Asian sovereigns with the BBB ratings, again, they have expressed skepticism over whether Axis and ICICI Bank can perform in the same way that some of the Asian peers with similar ratings can perform or no. Now, they have of course also mentioned that they believe that Indian banks will perform below peers over the next 1 or 2 years, and that the performance has largely bottomed out, and the sector is still struggling with poor asset quality and weak core. The question is, what is the street, what are the smart analysts thinking about what this downgrade means for these banks, and whether or not it's a big problem for ICICI Bank and Axis Bank? Well, CLSA doesn't seem to be thinking so. They have come out with the note, and in their note, they are saying that this is not as big an issue as it may be made out to be, because while the downgrades have come in, it does not necessarily impact the key function which goes behind what the stocks could do, which is that the credit costs are on the way down. And while this equates to a non-investment grade rating, it becomes a problem if other rating agencies follow suit, because the rating downgrades does not, or to their mind, may not impact the earnings. The overseas loan book, both on ICICI Bank and Axis Bank's part, is being consolidated and therefore not big of an issue. But as I said, that most people believe that the risks can arise if other rating agencies also downgrade the ratings of ICICI Bank and Axis Bank. They are sanguine on the prospects of both the banks, because they believe that the slippages are moderating, asset quality is improving. They believe there will be a turnaround in earnings coming in from FY20, and expect both banks to see a 15 to 16% ROE by FY21. So from a stock perspective, not a big thing. We might see a bit of a reaction on these stocks today, but if other rating agencies follow suit, then there could be an issue for both ICICI Bank and Axis Bank. So this is the big news that has come in on the two private bankers in today's session. Moving on, the third piece on First Word, corporate debt in India witnessed a sharp spike in the last financial year. If you look at the Nifty 50 companies, excluding financials, debt rose the most in 5 years. So which are the companies that borrowed the most during the period? Sumit Sarkar has a list. Sumit, and it's surprising because all through the last 5 years, we've been talking about corporate India deleveraging.
Well, if you see, actually that is not the case, because for the Nifty 50 companies, excluding the one belonging to the financial space, now that has increased, and it has increased the most in the last 5 years. Now there are nearly 39 companies that do not belong to the financial space in the Nifty 50 index, and of them nearly 4 are debt free. So the remaining 35 companies have seen an increase in that debt of nearly 13.4% to close to 16.3 lakh crore rupees. Now this is the biggest jump in the debt numbers, in the combined debt numbers in the last 5 years. However, the leverage ratio has remained largely stable at close to 2.4 times in financial year 2019. As you can see, it is largely stable for the last 3 financial years, but the debt amount has increased by nearly 1.9 lakh crore rupees in FY19. Now, which companies have contributed the most to this debt? Well, it has been led by Reliance Industries, NTPC, Indian Oil Corporation, UPL and Bharti Airtel. Now, these 5 companies have added nearly 79% of that incremental debt. So the Nifty 50 companies' debt has increased by 1.9 lakh crore, and these 5 companies have contributed nearly 1.5 lakh crore to that. And the other 5 companies that you can see are M&M, Grasim, Adani Ports, Tata Motors and BPCL, which have seen an increase in that debt of nearly 5,000 to 9,000 crore rupees in financial year 2019 compared to last year.
Okay, but Sumit, for some of these companies, at least the ability to service debt has definitely improved significantly. How do these companies stack up in terms of leverage? So
I'll start with the top 5 companies that I was mentioning, who have contributed nearly 79% to the total increase in debt. Reliance Industries tops the list. Now that debt has increased by nearly 53,000 crore rupees, and this is despite the fact that the company had done a demerger of the tower and fiber assets to lower that debt. However, that leverage ratio has come down below to around 3.2 times, and that is because of higher contribution coming in from the petrochemical and the consumer business. Now, interestingly, if you see, Reliance Industries now makes up for 17% of the total debt held by the Nifty 50 companies, which is the most at least since financial year 2010. Second on the list is NTPC. Now, their debt increased because of a higher capital expenditure, acquisition of a thermal power plant, and higher working capital due to advances to suppliers, which led to this 25% jump in that debt to close to 1,54,000 crore rupees. And the leverage ratio also moved up to 7.7 times because of lower operating profit in financial year 2019. Third on the list is Indian Oil Corporation. Now, their debt increased because of unpaid dues from government, because of higher payouts to shareholders, and because of higher capital expenditure in financial year 2019. The leverage ratio also worsened to close to 2.6 times because of lower operating profit. That was because of inventory losses that the company saw in financial year 2019. Fourth on the list is UPL. Now, their debt increased by nearly 22,000 crore rupees, but this was because of the big acquisition done by the company in FY19, that was of Arista Life Sciences. Now, that increased that debt to close to 28,861 crore rupees and worsened their leverage ratio to close to 7 times. However, going forward, the company is confident of maintaining its investment grade rating, and it is targeting to lower its leverage ratio to close to 2 times by FY21. So this is just a partial bump up that we are seeing in FY19 because of that acquisition. Lastly, Bharti Airtel. Now, their debt increased due to higher capital expenditure in FY19 and because of the competition that led to lower profits in FY19. Their leverage ratio, that is total debt to EBITDA, also stood at an all-time high of 4.9 times. However, post FY19, the company has done a rights issue of nearly 25,000 crore rupees to reduce its debt, and is also looking at various other options to bring down this debt further. So so far this leverage ratio of 4.9 would not be much of a concern, because the company is taking steps to bring down this leverage ratio going forward.
Okay, Sumit, thanks for putting that into perspective. This is the Nifty 50, and the absolute debt levels would have gone up for some of these, but on a leverage basis, maybe the things don't look so bad. And the other question is, in the next 200 companies, has the larger trend been one of deleveraging over the last 4 to 5 years? Just one small piece out here would also be that post July or post-August, once the IL&FS issue broke out, because promoters were grappling with the personal debt levels, I think the whole focus about deleveraging the company, etc., all of that would have gone out, because that's been the standout piece over the last 8 months when it comes to some of the mid-sized companies as well. So do bear these points in mind, but fantastic work, Sumit. The next piece on First Word is on innerwear. Now, higher disposable income often leads to individuals willing to spend a little more for some of the comforts in life, and that's exactly the trend was in the Indian innerwear space. The gradual but constant shift towards branded products prompted companies like Van Heusen to enter the segment too. But the cookie may now be crumbling. Agam is here to tell us why. Agam, why so? I mean, is the cookie indeed crumbling? Is this a flash in the pan, a blip? Or is this more structural, that after a big uptrend, we're now seeing a plateauing or a downtrend?
Yeah, well, there are a lot of complexities in this. Firstly, we have to understand that there's a very large unorganized market. So we may not be able to draw conclusions, but when it comes to listed companies, there certainly is a very big problem. And that is evident in the kind of revenue growth that we've seen for the fourth quarter, where if you consider the aggregate of the four largest companies, that is Page Industries, Rupan Company, Dollar Industry, and Lux Industry, the revenue growth has fallen to around 4.5%, and this is the first time in 6 quarters that it's been in the single digits. The last time we saw that was about 6 quarters ago, where it was about 1.2%. Let's move on and talk about how these companies have done individually, and if you remove Lux, Dollar Industries, well, it's actually, this number has been rounded up, because if you leave that aside, and that's seen, well, a single-digit growth. And of course, Page Industries, the biggest, has been flat. Rupan Company has actually seen a decline of as much as 2%. Now, moving on, what were these factors that were, well, working against the listed players? Almost all the companies have spoken about a certain liquidity squeeze in the distribution channel. There hasn't been too much going on. Let's not forget, the companies have been working on a high base because they came off last year after, well, the GST had set in, which is why they had registered very high revenues last quarter. And of course, let's not forget, there is a little bit of a rural distress at this point in time, which is impacting not only the mass segment. We must also remember that a very big chunk of the premium segment gets consumed in the rural areas too, surprisingly, and that is also bearing down on the way things are panning out, at least for the listed players out there. But can we call this a slowdown? Well, analysts for now are not willing to call it a slowdown. They are saying that we're going to have to watch out for the first half of FY20 in terms of sales to see whether or not this can be taken as some sort of suppression. Growth in premium and mid segment remains, that is the big growth potential for the entire industry, and that, save for Page Industries, we really haven't seen as much of an impact for the other companies. We are also expecting some amount of recovery in liquidity, but again, analysts are of the opinion that they want to wait for, well, some of these cues to come through in the first quarter and the second quarter of this financial year before we can actually call this a slowdown. Finally, coming down to valuations for these companies, well, they're all pretty expensive, at least as far as Page Industries and Lux Industries goes. And clearly, because Lux and Page will also command a reasonably higher well, operating margins. Page, of course, stands out clearly much higher than the others. Rupan Company and Dollar Industries, well, it's reasonably priced at 20-21 times. But the concerns for now remain as far as demand is concerned for the listed players.
Okay, demand for the listed players, maybe for the unlisted ones as well. We don't quite know that, but the listed players definitely. And as Agam said, save for Lux Industries, all the companies looking at either single-digit growth or in some cases very flat to negative growth as well. Fantastic work, Agam. Thanks so much for putting that into perspective. We normally talk about Page Industries as one player, but there are 2 or 3 others as well, and all of them very active. We'll talk more about this with the Managing Director at Dollar Industries, Vinod Kumar Gupta. He joins in at 9:30 a.m. and talk about this. Discuss rural distress, delayed monsoon, earnings and more with G. Chahal of Make Money Organics. But before that, we'll discuss the markets and macros with Andrew Holland of Avendus Capital Alternate Strategies. And after this break, a full tilt towards the day's trade.